I need you to stop what you're doing and look at this number. At exactly 10:22 a.m. Eastern on February 15th, the COMEX silver futures market reported an $88 floor price, a leaked Apple procurement contract benchmark, while the spot market traded at $60. That's a $28 gap. In a functioning market, arbitrage should close a spread like this in minutes. It hasn't. It's been widening for 3 hours. This isn't a pricing inefficiency. This is a mathematical impossibility under standard market mechanics. The last time we saw a comparable divergence was 1980, when the Hunt brothers tried to corner silver and triggered a systemic collapse. Today, major bullion banks are sitting on documented short positions totaling 350 million ounces. They cannot cover. When this spread continues expanding, these institutions face immediate liquidation risk, and the contagion spreads from precious metals into credit markets, sovereign debt, and commodity derivatives worldwide. At 10:22 a.m. on February 15th, COMEX silver futures opened with an $88 floor price embedded in leaked Apple supply contracts, while physical spot silver traded at $60. Think about what arbitrage means. If you can buy something for $60 and simultaneously sell it for $88, you print money until the prices converge, except the convergence isn't happening. By 10:45 a.m., the spread widened to $29. Look at the trapped positions. CFTC commitments of traders' reports from January showed commercial banks holding net short positions of 215 million ounces. These are bullion banks that provide market liquidity, and they're mathematically trapped. They shorted silver expecting prices to fall. Instead, they're facing a floor price $28 higher than where they can buy physical metal. The arbitrage math is brutal. There's no exit that doesn't accelerate their losses. What happens when institutions this size realize they can't close their positions without destroying their balance sheets? By 11:12 a.m., margin calls started hitting. COMEX reported margin requirements jumped 40% overnight, from $14,000 per contract to $19,600. 3 major hedge funds received margin calls totaling $890 million combined per SEC filings. Short interest on silver surged to 267 million ounces, 48% above normal levels. These funds bet silver would decline. They're now trapped where the floor price is $28 above their entry point. Here's the mechanism failure. Normally, shorts can cover by buying futures contracts, which forces price adjustment until futures and spot converge. But the Apple contract floor holds the futures price artificially high. Shorts are buying contracts, but the spread isn't closing because industrial buyers actually need that silver at $80 for production contracts. The market can't clear. What happens when these hedge funds exhaust their collateral and face forced liquidation? At 11:30 a.m., vault inventory reports dropped a bombshell. COMEX registered silver, metal actually available for delivery against futures contracts, declined to 127 million ounces, down from 142 million 2 weeks ago. Here's why this matters. The 267 million ounces of short interest means if even 30% demand physical delivery, that's 80 million ounces. There are only 127 million in registered vaults. Think of it like a bank run. As long as everyone trusts the system, paper claims work fine. But when people demand physical metal, the arithmetic breaks down. Exchange delivery reports show requests jumped 340% week over week. China's State Administration of Foreign Exchange disclosed a 15 million ounce physical purchase order. The vaults are draining. When registered inventory drops below outstanding delivery obligations, the exchange faces a delivery failure that would shatter confidence in the entire futures market structure. At 12:15 p.m., something unprecedented appeared in LBMA swap rate data. Normal silver forward rates run 0.5% to 2% annually. Today's 1-month rate, 4.2%. Negative. That means parties are paying to lend silver rather than charging interest to borrow it. This is extreme backwardation. In normal markets, you can borrow silver today, sell it at spot, and lock in a futures contract to buy it back later. The difference represents storage costs. When this flips to backwardation, immediate physical demand outstrips supply so dramatically people pay premiums for metal now rather than later. At 4.2%, the market is screaming for immediate physical delivery. Banks with massive swap exposure, Goldman Sachs, HSBC, JP Morgan's commodity desks, wrote swaps assuming normal conditions. Now they owe physical metal in a market where physical commands a 4.2% annual premium. A bank with $2 billion in swap exposure faces $84 million in annual losses just from the rate inversion. At 1:45 p.m., COMEX silver futures spiked to $91, a $31 spread from the $60 spot market. Bloomberg Terminal data showed volume surge to 12.7 million ounces in 15 minutes, triple the hourly average. Institutional algorithms were buying aggressively, trying to cover short positions. But here's the price discovery failure. Market makers pulled back. Order book depth reported by CME Group collapsed. At $88, there were sell orders for 2.3 million ounces. At $91, sell orders dropped to 340,000 ounces. The market is thin. Every large buy order moves prices violently because there's no natural seller. Silver producers can't ramp production. Mines operate on 6 to 12-month development cycles. The swing from $88 to $91 represents a 3.4% move in 90 minutes, annualized volatility of 1,140%. Long-only commodity funds like CalPERS sit on massive unrealized gains but face a trap. Liquidating at scale crashes prices. At $3 p.m., the spot futures spread hit $8.50 on the Shanghai Gold Exchange, the widest since March 1980. Shanghai spot, $89.50. COMEX futures, $98.00. Arbitrage should connect these markets. Buy silver in Shanghai, ship it to New York, deliver against COMEX contracts, pocket the spread. Except shipping takes 5 to 7 days minimum. During transit, if the spread collapses, your profit vanishes. Who's trapped? Sovereign wealth funds sitting on long-term allocated silver reserves. Norway's government pension fund Global disclosed 47 million ounces in precious metals holdings. China Investment Corporation holds an estimated 65 million ounces. These sovereign entities bought silver as inflation hedges. Now they're watching paper markets dislocate from physical reality. The $8.50 spread represents a fundamental price discovery failure. The market can't agree on what silver is worth because physical and paper markets have decoupled. At 4 p.m., COMEX announced emergency margin requirements, 50% hike to $29,400 per contract. If you're short 1,000 contracts, 5 million ounces, you went from posting $19.6 million to $29.4 million, a $9.8 million increase due immediately. Can't post it? The exchange force liquidates your position, buying contracts at market prices regardless of cost. That buying spikes prices further, triggering more margin calls, creating a liquidation cascade. By 4:23 p.m., Bloomberg reported forced liquidation of a European bank's silver book. 8,300 contracts bought at market in 12 minutes. The buying spiked futures from $98 to $106, an 8.2% surge. Every other short just got $8 deeper underwater. U.S. commercial banks holding 143 million ounces in net shorts need to find $1.4 billion in cash immediately. The vicious cycle is locked in. Margin hikes force liquidation. Liquidation drives prices higher. At 5 p.m., the largest silver ETF, iShares Silver Trust, SLV, reported withdrawal requests totaling 52 million ounces. A 9.5% single-day withdrawal request is unprecedented. The problem? SLV traded at a 4.7% discount to net asset value by 5:15 p.m. Why? The trust's custodian, J.P. Morgan Chase, is reportedly delaying physical delivery due to vault logistics constraints, per an internal memo leaked to Reuters. The subtext, they might not have all the metal. ETF investors think they own physical silver. In reality, they own shares of a trust that owns claims on silver stored in vaults. If those vaults can't deliver, the shares become worthless. Retail investors hold $23 billion in SLV shares. Millennium Management disclosed a 7.2 million share position. Bridgewater Associates holds 3.8 million shares. These sophisticated funds are now locked in an ETF trading at a discount because nobody trusts it can actually deliver metal. At 6:30 p.m., CFTC's Supplemental Commitment of Traders report showed silver short interest hit 389 million ounces, 106% of COMEX registered vault inventory. Short positions exceed available metal. Today's delivery demand, 87 million ounces requested for March settlement, is 68% of registered inventory. If April and May contracts also demand delivery at similar rates, the vaults mathematically cannot supply metal. The largest institutional shorts, swap dealers are short 178 million ounces, managed money is short 82 million ounces, other reportables are short 129 million ounces, combined 389 million ounces. The short squeeze mechanics are now inevitable. To close a short, you must buy, but every buy order moves the price up $1 to $2. Goldman Sachs published an estimate. If 25% of shorts cover within 1 week, COMEX silver could hit $180 to $200 based on historical volatility and order book depth. At 7 p.m., contagion emerged from the London Metal Exchange. Nickel futures spiked $4,200 per ton, a 19% surge in 90 minutes. The connection: major commodity trading houses operate across metals markets with shared credit lines. When silver margin calls hit, firms like Trafigura, Glencore, and Mercuria face liquidity crunches. To meet silver margin, they liquidate other positions. If everyone deleverages simultaneously, it creates forced buying in short markets and forced selling in long markets. Copper futures dropped 7%, aluminum fell 4%, zinc declined 5.5%. The Bloomberg Commodity Index moved 3.8% intraday, the largest swing since March 2020. Castleton Commodities International disclosed $48 billion in commodity trading positions. A 3 to 8% adverse move across their book could mean $2 to $3 billion in losses. Banks providing credit lines face counterparty risk. If traders default, banks inherit positions and must liquidate at a loss. By 8 p.m., COMEX and LME issued emergency statements. Trading in silver futures suspended until further notice, pending extraordinary market conditions review. The exchanges couldn't manage the volatility and liquidation cascade, so they stopped the game. Hong Kong Mercantile Exchange followed with its own suspension. Who's trapped now? Everyone. Longs can't exit. They're locked into contracts with no market. Shorts can't cover. They remain exposed to whatever price emerges when trading resumes. Regulatory bodies, the CFTC, UK's FCA, Hong Kong's SFC, face a political nightmare. If they allow trading to resume without intervention, the short squeeze bankrupts major banks. If they intervene to cap prices or force cash settlement, they destroy market integrity. The 2022 LME nickel crisis provides precedent. When nickel spiked to $100,000 per ton, LME canceled $3.9 billion in trades retroactively to save Tsingshan from bankruptcy. At 9 p.m., off-exchange markets showed silver prices continuing to rise. Over-the-counter dealers in Dubai, Singapore, and Zurich reported physical silver bids at $127 per ounce, a $67 premium over the last COMEX print. With exchanges closed, price discovery moved to opaque bilateral markets. The spread between frozen futures and live physical markets exceeded $40. Sovereign wealth funds, central banks, and pension funds holding silver-backed securities watched their positions become unmarketable. What's the next domino when silver hits theoretical highs in unregulated markets while official exchanges remain frozen? At 10 p.m., emergency meetings convened as regulators scrambled to contain the crisis. Rumors circulated of a coordinated bailout. Central banks would provide swap lines to exchanges, allowing cash settlement rather than physical delivery. But the mathematics remain unforgiving. Even with forced cash settlement at $100, shorts owe $40 per ounce on 389 million ounces, $15.6 billion in losses. Several European banks could see quarterly losses exceed total equity. Credit default swap spreads on major banks widened 47 basis points, signaling bond market smell blood. Is this the beginning of silver market collapse? Will it bring down the broader economy when counterparty failures cascade through global banking?